Video, we'll be going over IRS Form 8936, Clean Vehicle Credits. So I updated this video in the summer of 2024 when the IRS changed it from the Qualified Electric Motor Vehicle Credit or something to Clean Vehicle Credits. And I was recently asked to take another look at the 2024 version, which recently came out, because there are even more changes. So the additional changes include the fact that starting in 2024, a taxpayer who would be eligible for the Clean Vehicle Credit is able to transfer that credit instantly to their car dealership. Basically, if you go into a Tesla store, for example, and you buy a $50,000 Tesla and they say that you're eligible for the $7,500 credit, well, in previous tax years, you would have to purchase the vehicle and then wait through the end of the tax year and then claim the credit on your tax return and then eventually get a refund. And if you bought your vehicle in January, then you would have to wait over a year just to get the credit. So what this transferability allows you to do is you get the cash instantly, and then in exchange, because the dealer is either paying you cash, like taking the credit off as a down payment or as a partial payment on your vehicle or in installments, however you arrange it, that credit is something that the dealer can claim on their tax return, but you get the money up front. So you still have to report that transferred credit on your IRS Form 8936, and you still need to complete a Schedule A for that vehicle. But what that means is you're not getting that tax credit. You're not waiting for up to a year or more to get that tax credit applied to your tax return. You're getting cash in hand or a reduced payment balance on your vehicle when you walk out the door. So that's kind of a good thing. Unfortunately, there's really no stipulation that allows you to take the cash and then turn around and claim the credit. So you have to report that on your tax form, even if you transferred it, so that your dealer, when your dealer claims a credit, the IRS can cross-reference your tax returns and based on the vehicle identification number, and then determine that the right taxpayer entity is getting the credit. So the IRS tries to make sure that there's a safeguard in place so that people aren't double dipping or taking advantage of the tax code. So what we're going to do is first talk about what the clean vehicle requirements are. So a clean vehicle can be either an electric motor vehicle or a fuel cell vehicle. Basically, a qualifying clean vehicle is a new vehicle with at least 4 wheels placed into service after 2022 that is propelled by an electric motor that has a capacity of not less than 7 kilowatt hours and can be charged. It's used primarily for public streets, roads, and highways. Has a gross vehicle weight rating of less than 14,000 pounds. Had the final assembly in North America. Has a manufacturer's suggested retail price of not more than $55,000, but for a van, SUV, or pickup truck, that becomes $80,000. And then meets certain other requirements under the Clean Vehicle Certification requirements. A qualified fuel cell motor vehicle is one that generates electricity by combining oxygen with hydrogen. It's used primarily for public streets, has the same price and assembly requirements. And then there are also requirements for a previously owned vehicle. We'll get into that we'll get into it right now. So a previously owned clean vehicle has a model year that's at least 2 years earlier. So if you bought it in 2024, it would be a 2022 model. Was originally belonging to someone besides you, does not have a sales price of more than $25,000. You're the first person that was transferred, or you purchased it from a registered dealer, and this is the first transfer. Meets the same specifications as the new vehicle. And then there are additional requirements for commercial vehicles. We cover a little bit more of that in our article. So if that pertains to you, check out the article. We go into detail about the new vehicles, the previously owned vehicles, and the commercial vehicles. So what we're going to do is we're going to cover IRS Form 8936. It has 5 parts. We'll talk in depth about the modified adjusted gross income amount. Part 2 and part 3 kind of work with each other. So if you're a personal, like if you're an individual filing a tax return, you may or may not have the business use of this. You could report that through your S corporation or partnership, or you would report it on IRS Form 3800 as part of a general business credit. So you could still apply this if you were filing a Schedule C, for example. But basically, whatever you don't take for the business part, you could possibly use for the personal part. You just can't combine them for more than the total amount of the credit. So whatever you don't use the vehicle for, like if you use the vehicle for business 50% of the time and use it for personal use 50% of the time, then you would divide that, call it a $7,500 credit, between parts 2 and 3. If it was a previously owned vehicle, you would use part 4. And then if it was a commercial, a qualified commercial clean vehicle, then you would use part 5. But these are pretty straightforward. What's probably a little bit more technical is the Schedule A part of this. So we're going to start with that, and then we'll go back to the Form 8936. So Schedule A, you have to complete a separate Schedule A for each vehicle you placed into service during the tax year. So if you bought, like, say, 3 separate vehicles for business purposes, you would be completing 3 separate Schedule A's that all feed into that one Form 8936. And if you transfer the credit to the dealer at the time of sale, you still have to file the Schedule A. You still have to file the 8936. There's still a little bit of guidance confusion in the form instructions. I went through them a couple of times, and we'll do the best that we can. You're still going to report it. You're still going to check some boxes, but it says refer to the instructions quite often. And when you go to the instructions, there's really not a whole lot more information. So let's go ahead and start with part 1 of this. And in this scenario, John Doe bought a Tesla Model S. We'll say it's for personal use, but we will kind of break down different scenarios on how this would work if it was a business use vehicle or a clean commercial clean vehicle. So in lines 1A, B, and C, we've got the year, make, and model. So 2024 Tesla Model S. In line 2 is the VIN, the vehicle identification number. It should be the same VIN that's in the title, the registration, the dealer paperwork, stamped on the vehicle in multiple places. This is going to be the number that is cross-referenced with the dealer's tax return as they're reporting all the vehicles that they may be claiming the credit on. So this is why you would report your vehicle even if you transfer the credit, so that the IRS can then turn around and cross-reference that with the dealer's records. In line 3, you'll enter the date that the vehicle was placed into service, which was, in this case, we just put down January 15th, 2024. And then in this scenario, we're going to say that John Doe did not transfer the credit of the dealer, but if he did, you would enter the transferred amount. So let's just say that he transferred the $5,000 credit, like he was eligible for a $5,000 credit. I think I went to the Tesla store the other day, and I think they say up to $7,500. So let's just say $5,000. So you would enter that. But then you would, if line 4A is yes, you would complete either line 8 or line 13, and then you'll check here if directed to do so. So really quickly, we'll just, line 8 is the part for credit amount for business or investment use. And then line 13 is the part for a previously owned clean vehicle, which may or may not apply. So if you don't have anything for business use, you would still go through all of this, which we're about to do, and then you would complete part 3. So, so in either way, we'll go back to, we'll go through all of that, and then when we pick up on lines 8A, 8D, I believe they kind of kick us back up to the box in line 4A. So we'll be coming back up here periodically. So let's go ahead and just delete this for now. In line 5, does the VIN belong to a new clean vehicle placed into service during the tax year? So if it meets the criteria that I outlined earlier, then you would say yes, you would complete part 2. If it meets the criteria for a previously owned vehicle, then you would say yes, go to part 4. And then if it was a qualified commercial clean vehicle, then you would say yes and go to part 5. And if you can't say yes to either line 5, 6, or 7, then you're just going to stop here. Your vehicle, this vehicle does not qualify for a credit. So it has to meet the criteria for one of these 3. We're going to go ahead and say that what meets the criteria for part 2, which is the business investment use amount. And then we'll kind of walk through the rest of the scenarios accordingly. So if we said yes, we actually would just probably leave these blank. In part 2, first question is, did you resell the vehicle within 30 days? If you did, then you can't claim the credit. And if you already claimed the credit because you kind of walked through that process with the dealer, which, did you transfer the credit? You're now having to basically repay that credit back to the IRS because you're not eligible for the credit, but you transferred it to the dealer. The dealer's going to claim the credit, and the IRS is going to make sure that one of you pays them back. So you can't take the credit, and then the dealer can't take the credit unless you've paid it back. So if it's line 4A is yes, you would check the box on line 4B. You would report the line 4A amount on Schedule 2, line 1B. So that's an additional tax that you would pay to the IRS. And it's not an additional tax. It's structured as that, but it's really repaying the credit that you took even though you weren't eligible for it. In line 8B, it asks if you're filing this with an income tax return. So check yes or no. For this instance, we're going to say yes. We are filing it with a tax return. So if no, then you would skip line 8C, 8D, and then you go to line 8E, which is to whether or not you acquired it for use or lease to others. So lines 8C and 8D are kind of similar. You have to go back to the form itself, complete lines 1 and 2 here. So the lines 1 and 2 happen to be the first part of the modified adjusted gross income. So in this is the first year for 2020, or the current year for 2024. So, and then you have to make sure that your line 2 amount is under these AGI limits. So since we're completing part 2, we're going to use this column. If we were completing part 4, it would be this column. So let's just say that we went through all this and John Doe is clearly under the threshold for being able to claim this. Doesn't matter if he's single or filing married, he just meets the criteria. So if he meets the criteria, then he can if he meets the criteria and he's under, then you would say no. So if you say yes, then you have a chance to go back to the prior year tax return so 2023 in this case, and you would do the same thing for your prior year tax return. So let's imagine that that's exactly the same. So let's envision a scenario in which this is well over the mark. So let's just say you made $3 million this year. Uh, the IRS would allow you to go back to prior year and see if you meet the criteria there. Oh, it looks like that $3 million was just a one-time incident. You know, we go back to the prior year, he's under the threshold. He can still claim the tax credit. That's kind of how that works. So let's go back to Schedule A. Let's just say that now, if we're in line 8D and he exceeds the threshold for both 2023 and 2024, then he can't claim the clean vehicle credit for this vehicle. So if he already transferred it and indicated that by checking the box in line 4A or saying yes in line 4A, then he needs to check the box in line 4B, report that 4A amount on Schedule 2. He's paying back that credit. So now, if you say no and you transfer the credit back to the dealer at the time of sale, stop here and see the instructions. Well, this is where the instructions are a little bit kind of fuzzy. So there's not really a lot of clear guidance here, basically. Your tax software should pick up on this, should transfer and calculate your overall tax bill without the credit. I can't say that for certain because the tax at the time of this recording, tax software for 2024 tax year hasn't been released yet. That's how I would imagine it going down. So if you didn't transfer the credit to the dealer, then you can just keep going. So did you acquire for lease, for use or to lease to others and not for resale? So basically, did you use this for business or are you going to turn around and sell it? So if you're leasing the vehicle, then you would say no, as if you were going to turn around and sell it. So you can't claim the credit if you're leasing it, and you can't claim the credit if you're going to turn around and resell it. So, but if you bought it for normal business use, then you would say yes. And let's just imagine the tentative credit amount, which would be provided to you by the seller when they sell it to you. So all the car dealerships are going to be telling you exactly the amount of credit, and they're responsible to the IRS for reporting the correct amount based on IRS and federal government guidance to automotive manufacturers and dealerships. So they have to file separate paperwork that you may or may not see to the IRS, and they have to report that the amount that they told you to put here is the amount that you're actually entitled to according to the federal regulations. So let's say it was that $5,000 amount. Now you decide how much you're using this vehicle for personal use versus business use. So if it's only business use, then you would put 100%. If it's only personal use, you would put 0%. But sometimes people buy a vehicle for personal/business use. You should determine that based on the percentage of miles. So if you drive your car 20,000 miles, you might be inclined to say it's 50-50, but then if you keep track of your mileage the way you're supposed to for business tax write-offs, and you find out that you only drove 5,000 miles for business and 15,000 miles for personal use, then you would write the 25% here, and then you would calculate 25% of that tax credit. So it would look like this. And then you would subtract this amount from this amount, and you would get the amount that you can use on personal use. So that's how you would do that for the personal use part of a clean vehicle. You would then include this in line 9 of part 3. So line 9 is right here. You would put in your $3,750, and then you would determine your tax liability, which is this line right here is your total tax bill plus the amount that was in line, it's from IRS Form or Schedule 2. So basically, you would have to determine the amount that is on your Schedule 2 to go into this amount. So there isn't further guidance on this in the instructions, but basically line 18 happens to be right here. So the amount of your tax bill here, and then the amount of your Schedule 2 line 3, and you would combine those to get your line 16 and 17. It used to be a little bit more straightforward. Like we could dig down into Schedule 2, and it was very simple to pull out those numbers. That schedule has been changed too, so it's a little bit more complicated. So just take the line 18 amount from your Form 1040. So let's just say that this amount is $10,000. And then let's say that his personal credits from his Form 1040 are $2,000. So you would subtract this, the personal tax credits from the $10,000, you get $8,000. And then the personal use part of the credit is the smaller of these two, either the $3,750 or the $8,000. So let's say that's the $3,750. You would report this on Schedule 3 of your Form 1040, line 6F. This is one of those non-refundable tax credits. So what it can do is it can reduce your tax bill to zero, but it can't create a tax refund. So unlike certain credits like the Earned Income Credit or the refundable part of the American Opportunity Tax Credit or the Child Tax Credit, or part of the Child Tax Credit, those are refundable tax credits, which mean they can drive down your tax bill to zero, and then they can generate a refund if your tax bill becomes negative. But let's imagine that you get this $3,750 credit, but your tax bill is only $2,000. What happens to the remaining $1,750? You lose it. So it's kind of a use or lose. You can't carry it back a year. You can't carry it forward. So kind of keep that in mind. If the reason you're purchasing your clean vehicle, if the big selling point is a tax credit, take a quick look at your taxes to make sure that you're in a position where you would take advantage of the entire tax credit. So that's kind of just a piece of guidance for people that are still mulling the tax impact of their Tesla purchase or whatever clean vehicle you happen to be buying. So there are a lot of people that are kind of disappointed because they thought they were getting the full $7,500 credit, and they may only be able to use like $3,000 or $4,000 of it. Let's see. So let's go back to the Schedule A, and let's just pretend this is a previously owned clean vehicle. So first question, did you resell it within 30 days? Just like, part two. So let's say no. You would do the AGI limits again. So let's just say that they actually, you meet the AGI limitations for the current tax year. So we can skip down past line 13C and go to 13D. So this is another important distinction. So previously owned clean vehicle credit, you can't have claimed that credit for another vehicle that you purchased in the 3-year period as defined by within 3 years of the date that you purchased the vehicle. So if you bought the vehicle, John Doe buys it in January 15th of 2024, that look back period goes to January 15th of 2021. So if he claimed the previously owned clean vehicle credit for another car in 2023, you can't take this credit this year. And you can't take it for this vehicle. So if he's claimed the new clean vehicle credit, he can still take this credit. You can purchase other new clean vehicles. You just can't claim the same clean vehicle credit for a previously owned vehicle more than every 3 years. In line 13E, is the sales price more than $25,000? If it is, then it doesn't qualify. Did you acquire for use and not for resale? We'll say yes. And again, if you're leasing the vehicle, that counts as a no. And then finally, can you be claimed as a dependent on someone else's tax return? Most common scenario would be someone being claimed as a dependent on their parents' tax return, but certainly people can be claimed on their children's tax return, cases like elderly parents, for example. So if an elderly parent went out and bought a car, but their, John Doe is his daughter's dependent on her tax return, then he can't claim this credit. So let's just say none of these weird situations apply. We're going to enter the sales price of the vehicle. Let's call that $20,000. Can't be more than $25,000. So we multiply that by 30% because that's the maximum calculation for that is 30% of the sales price. And then we'll match that against the maximum credit vehicle amount, which happens to be $4,000. So the most credit that he can take is $4,000. So effectively, that 30% tax rate comes to basically a limitation of somewhere around, I want to call it somewhere close to $14,000 or $15,000. So, the 30% up to a limit of $4,000. Part 5 is the credit amount for a qualified commercial clean vehicle. So we'll walk through this separately. There are some other stipulations here. So if you made an elective payment election, which is kind of a relatively new situation, then you would enter the IRS registered or IRS issued registration number for the vehicle. You would also enter whether or not the vehicle is subject to depreciation. So if it's not subject to depreciation, it's not a qualified clean vehicle unless it qualifies for a certain exception. And you can find those exceptions in the instructions or in our article. Line 18C is the did you acquire this for use or to lease to others, not for resale. If you bought it for resale or if you're leasing it, you can't claim the credit here. And then finally, is this vehicle powered partially by gas or diesel? So if it's partially powered by gas or diesel, then the instructions state that the commercial clean vehicle, which includes a new qualified fuel cell motor vehicle, does not have to be solely electric or fuel cell driven. It can be partially powered by a gas or a diesel engine. However, the credit rate is reduced from 30% to 15%. And we'll get to that in just a second. So let's just say no, it's a purely electric pick-em-up truck or semi. The gross vehicle rating, you would enter that. Let's just say that it's a vehicle rating 30,000 pounds. I don't know how much trucks or other vehicles cost or weigh, but let's just say that sounds like a good number. I think it's within the parameters. And then let's enter the cost or the other basis of the vehicle. Let's say that this was $70,000. Again, I don't know whether or not that really is a realistic one. So you can enter any Section 179 expense deduction that you claim for the vehicle that basically reduces the basis of your vehicle. So let's enter 0. We'll just say that we filled out IRS Form 4562. We elected not to expense any part of it. That's probably not what most people would do, but let's just go ahead and say that that's what we did. We now get to multiply the line 21 amount by either 15%, However, if this is a purely electric vehicle, then you still get the 30%. So let's just say it was 30%, so that's $21,000. The incremental cost of the vehicle is defined as the amount that's equal to the amount above the purchase price for a comparable vehicle. So let's imagine that you bought a semi. Let's say that this is a semi. It's probably not, but let's say that a typical semi would be $50,000, and you bought this one for $70,000. The incremental price would be $20,000. That's the difference. So let's just say that. And then let's take the smaller of those two. So either line 22 or 23. Well, So I accidentally did that. Good thing we're almost done with this whole section. So let's go back down to here. I believe this was 21,000. I'll repopulate these lines as needed, but let's take the smaller of these two. And now we're going to enter the maximum credit. So the maximum credit is $7,500, but if the gross vehicle rating was 14,000 pounds or more, then that becomes $40,000. So in that case, you're getting the smaller of either the maximum credit, the incremental cost of that vehicle, or the amount that you did not expense. So if you expensed it for taxes, you lose the amount that you expensed as the credit. So you probably should sit down with your tax person and figure out, the numbers on your purchase. This is a little bit more complicated because there are a couple of ways where you could lose out on the best possible tax benefit. And again, you have to balance the tax benefit with your business use. So the tax credit or the tax treatment should always be it should be an incentive, but it shouldn't be the sole driving factor. For business purposes, it should always be the decision that makes the most business sense. And there are other factors that could alter your calculation based on the entirety of your tax situation. So let's go back. So sorry, those are the instructions. Let's go back to this. We never really went through parts 1A, B, and C, and D, but basically you're taking your adjusted gross income, and then we're adding back certain parts of income that you excluded. So if you earn money in Puerto Rico that was off of your tax return, you would add that back in. That's in line 1B. IRS Form 2555, that's your foreign earned income exclusion. It could either be your income exclusion or your housing allowance exclusion. Lines 45 and 40 and 50 represent two different exclusion amounts from that tax form. So if you're completing that, you have to add those back in. And then IRS Form 4563, I believe that's the amount that you excluded from income that you earned as a resident of American Samoa. So Puerto Rico, anywhere overseas where you took the housing exclusion or the earned income exclusion, or American Samoa, you have to add those back in. And you don't have to do all of these. If you qualify on 2024, you don't have to look back to 2023 to qualify. It's one or the other, but not necessarily both. And again, part 2 was the amount that we figured in part 2 of Schedule A. So let's say that this was that $1,250 amount. If you had line 7, which is a pass-through from any other partnerships that might have passed that down through your K1, let's just say that was $1,000, then you would add those two together. So if you're a partnership or an S corporation, you're going to put that on your Schedule K. Everyone else is going to put that on their IRS Form 3800, line 1Y of Part 3. That is the general business credit form. That's the kind of the catch-all for all of these different types of business credits that you may be eligible for. They all get consolidated into Form 3800, and then based on your tax filing status as a business entity, it gets distributed accordingly. The credit for previously owned clean vehicles. So let's imagine that we put that amount as, I forgot, let's just say we qualified for the maximum of $4,000. Again, you're walking through this to make sure that we don't unnecessarily, or that we're claiming what we're entitled to, but it can't generate a tax refund. So if our tax bill was $10,000 and let's just say we didn't have any credits, then we should be in the clear because we would take the full $4,000. But let's say that our tax bill was only $2,000, then we would have to basically only claim the $2,000. We would lose the rest. So this looks a lot similar to part 3. And then part 4 or part 5, this is the amount for qualified commercial clean vehicles. So let's say we had, what do we have back here? We had, well, let's just say that this ended up being $20,000. So we would take that number, we would put that here, and then we would include any pass-throughs of commercial clean vehicle credits, add those two together. Partnerships and S corporations will report that on Schedule K, and then just like up here, this is a different tax credit. You would report it on line 1AA in Part 3 of your Form 3800. If I didn't state this earlier, there is the personal use part of the credit. So once you calculate either line 13 or line 18, you're going to take that amount and report it on Schedule 3. So for the personal use part of the clean vehicle credit, you're going to report that on line 6 of your Schedule 3. And then for part 4, you would report that on line 6M. So line 6F, line 6M. They all kind of calculate to the same total amount. I just redid the video for Schedule 3 a couple days ago. It doesn't look like the math makes much of a difference. So the only thing I can assume is that the IRS really wants to keep track of those in separate parts of Schedule 3 for maybe statistics purposes, like trying to figure out, which taxpayers claim the new clean vehicle versus the previously owned vehicle credit. So, and then there's a little bit of difference in the new clean vehicle for business use versus the qualified commercial clean vehicles. So, where you can have like a regular car versus maybe like a clean semi truck or a heavy duty vehicle. So I think we've covered pretty much all the details, the new nuances of IRS Form 8936. So we'll put links in the show notes to all the articles and videos that we've created about forms and schedules that we mentioned here. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.